All right, let's get right into it. For months, it feels like all eyes have been on the US Fed, right? But what if I told you the real story? The one that could seriously shake up your portfolio is actually unfolding about 6,000 miles away in Tokyo. It's this fascinating financial mystery that connects a single decision in Japan to the price of, well, pretty much everything, from Bitcoin to your favorite tech stocks.
So that brings us to the big question we're going to unpack. How is it possible that one move by the Bank of Japan could trigger what some analysts are calling a giant global margin call? It sounds crazy, but the answer lies in one of the market's biggest and, honestly, most overlooked secrets. And it all starts with this, a warning from Tokyo. While most of us are glued to every little update from the US Federal Reserve, a financial experiment that has been running in Japan for decades is finally winding down, and we're just now starting to see the ripple effects. To really get what's happening, you have to rewind the clock a bit. For more than 20 years, Japan has basically been the home of the world's cheapest money. See, to fight off deflation, their central bank pushed interest rates down to near zero, sometimes they were even negative. And this created this really unique, and let's be honest, very tempting opportunity for investors all around the globe. This opportunity is what gave rise to something called the yen carry trade. Now, this isn't some obscure strategy for finance nerds. For years, this has been like a secret engine quietly pumping trillions of dollars into global markets, pushing up the prices of assets pretty much everywhere. So what exactly is it? Well, the concept is actually surprisingly simple. It's a strategy where big players, we're talking hedge funds, major institutions, borrow money in a country with super low interest rates, like Japan, and then they turn around and invest that same money in a country with higher interest rates, like the US, and they just pocket the difference. It really breaks down into 3 easy steps. Step 1. You borrow huge, and I mean huge, amounts of Japanese yen for practically nothing. Step 2. You swap all those yen for US dollars. And then, step 3, you take those dollars and buy assets that give you a much better return. Things like US Treasury bonds, big tech stocks, maybe even crypto. For years, it was like a risk-free money machine. As long as one thing stayed true, Japanese rates had to stay at zero. But now, the game has totally changed. That decades-long party is officially over, and it's kicking off what people are calling the Great Unwinding. The entire foundation that this trade was built on is starting to crack. So you might be asking, why now? Well, the past was all about those near zero rates from the Bank of Japan. But the future looks a lot different. After struggling with deflation for years, Japan is finally seeing inflation start to stick around. And that's forcing its central bank to do the unthinkable. They're starting to raise interest rates. There's this quote from barchart.com that just nails it. If the BOJ raises rates even modestly, the entire equation changes. And that's the whole story right there. All of a sudden, borrowing yen isn't free anymore. And maybe even more important, as those rates go up, the yen itself gets stronger, which makes paying back those massive yen-based loans a whole lot more expensive. And this is where you get this potentially terrifying domino effect. As this whole trade unwinds, it could set off what's being called a global margin call. You'd see investors being forced to sell their assets, not because they want to, but because they have to, in order to cover those yen loans that are suddenly getting so expensive. And the scale we're talking about here is just staggering. A study from the Bank for International Settlements put the size of this yen carry trade at around $1.7 trillion. Think about that. That is a colossal amount of capital that's been artificially propping up asset prices all over the world. So which assets are feeling the heat the most? Well, it's the very same things that had a great time on the way up. We're talking about popular US tech stocks, US government bonds, crypto, commodities. When all those yen-funded bets get unwound, it just creates this huge selling pressure across the board and sucks liquidity out of the system. Now, I know what you're probably thinking. Trillion-dollar unwind, forced selling, global contagion. It all sounds a little bit like 2008, doesn't it? But this is maybe the most important part of the story. This is a reset, not a wreck. Let's be clear. The 2008 crisis was about insolvency. Banks were actually failing because they were holding tons of fundamentally bad debt. The system itself was on the verge of breaking. What's happening now is what's called a funding repricing. It's about deleveraging because the cost of borrowing money has changed. Yeah, it's painful for traders caught in the middle, but it's not a systemic credit crisis. So here's the key distinction. Traders getting squeezed on a leveraged bet is not, and I repeat, not the same thing as the entire financial system going down. What we're witnessing is a massive repositioning of capital, a really turbulent adjustment to a new world for interest rates. Think of it like a plumbing issue for the markets, not a foundation-cracking earthquake for the global economy.
And really, what this all points to is a much bigger long-term shift. For the first time in forever, Japanese bonds are starting to offer an attractive yield. So what happens? Capital starts to flow back home to Japan. They call it repatriation. Analysts over at RBC Capital Markets are calling this a sea change that's going to reshape markets by 2026. It's a fundamental shift of capital that's going to create a whole new set of winners and losers for years to come.
So, yeah, the short-term turbulence is definitely real. But the most important thing to take away from all this is the question it forces us to ask. When trillions of dollars are set in motion by a structural shift this big, it's not just about managing risk. It's about what happens next. As these old, easy trades die off, and all that capital looks for a new home, what new opportunities are going to rise up out of all this volatility?